Since this is the first session, we are handling income tax. It is good to just have some background before we start handling calculations. For purposes of our computations, obviously you need to know what are types of taxes we are talking about here. Of course, we have current tax. We have current tax and deferred tax. Okay, these are two types of taxes we need to know. With current tax, this is tax on profits made in the current year. Okay. Tax on profits. This is tax tax on profits made in the current period. And obviously, for purposes of our country, Uganda, the tax rate is 30%. So you get that 30% times the profit. That is profit before income tax. There you will have your current tax. Okay. Then deferred tax. Simply with deferred tax, this is a tax that reconciles. It is tax that reconciles accounting and tax principles. Yeah, with the deferred tax, it's just simply it arises when we are trying to actually reconcile the accounting principles with tax principles. Because you know that as we prepare the financial statements, accountant is going to rely on the what? On the accounting standards. But the taxman will be using tax principles or the tax laws. So in the long run, you'll find that you have differences which must be reconciled. We needed to know the recognition. We need to know the recognition. Oh, colleagues, you know all these things, you just need to start answering the question. But I find it not good to start answering the question minus a background. What is your view, colleagues?
We can go on. We can summarize it. Just I think it's okay.
It is good to have the summary. Then you will start the calculation.
Let us first have the overview of the things so that we get the concept.
Okay. Now, with recognition, we need to know now. You have current tax. How are you going to recognize the current tax? Current tax is recognized as both both an expense in profit or loss account and the current liability in statement of financial position. This is recognized as both. You know that in your income statement, you'll be having that element of income tax. That is number one. You recognize that in your profit. Recognize both as is recognized both as an expense, okay, in the profit or loss account, and the current liability, in our statement of financial position. That is balance sheet. And why are you taking it to current liability in the balance sheet? That is in the situation where as a company you have not paid the tax during the year. You have prepared everything, you have computed the tax, but that tax is not yet paid, that tax for the current year. And because it is not yet paid, it will create this item. It it will appear in your current liability under the balance sheet. Okay. What about deferred tax? What about deferred tax? And colleagues, if I talk about something and you need more clarification, please unmute and ask. Or if you want to supplement something, you also unmute and supplement. Okay. Now, with deferred tax, you're going to look at two items. One, you look at deferred tax liability and deferred tax asset. Now, with deferred tax liability, this is a non-current liability, is a non-current liability in the statement of financial position. Okay, that's what you needed to know, number one. If it is a deferred tax liability, how are you going to recognize? You're going to recognize, or you're going to record that deferred tax liability in your non-current liability. Okay. Now, you may have a situation where you find that you have an increase, or a decrease in deferred tax liability. Now, if it an increase in deferred tax liability is a tax expense. Okay. Then a decrease in a decrease in deferred tax liability is an income, is a tax credit. It's an income. Call it tax credit. Okay. That's what you needed to know. Colleagues, is it clear?
Abel, I was asking, pardon, on the current liability.
Okay, Samasa. Your current liability, I'm saying, one, remember first to know what is current liability. Current liability is tax on profits made in the current what? In the current period. Okay, you are going to compute the tax. You have the tax here. You have profit before tax. Then you go ahead and compute your tax at 30%. 30%. This is profit, 30% of profit before tax. Okay? This tax you're computing is not yet paid. You're just computing the tax. You have known the tax, but this tax is not yet paid. You're closing the year of income when, let's say, you have not yet cleared this tax. Okay? And if you have not cleared this tax, it means that it will be like a liability to the side of the what? The side of the company. So that's why I'm saying it is recognized as both an expense in profit or loss account. An expense we are talking about here in this one. Okay. Then when you're preparing balance sheet and current liabilities, you also bring.
I wish to open the discussion with those few remarks, and I thank you, and I wish you.
Someone is having two discussions.
I don't know whether it is making sense to you, but that's according to me. Then when you're looking at deferred tax, don't confuse this deferred tax with current tax. Basically, with deferred tax, let's first understand now what we are talking about here. You will basically deferred tax. We are looking at the differences in accounting principles and tax principles, and maybe it can also arise because of the revaluation gain. Because of the revaluation gain, as we are going to see some numbers. Now, I was saying that deferred tax here can be categorized into two. Deferred tax can be categorized into two. One, I was saying deferred tax can be categorized into two. One, you have deferred tax liability, and deferred tax liability is a non-current liability in the statement of financial position. And an increase in the deferred tax liability is a tax expense. We know that if you know that if your liabilities increases, it means that you're creating also an element of expense. But if your liabilities decreases, then that is an income, or for purposes of tax, that is like a tax credit. Okay. Then with number two, we have deferred tax asset. We have deferred tax asset. With the deferred tax asset, this is a non-current asset in a statement of financial position. Deferred tax liability is a non-current liability. Then deferred tax asset is a non-current asset. Then an increase in the deferred tax asset is what? An increase in a deferred tax asset is a tax credit. Look at this as an income. Then a decrease, it's like opposite of the first one. A decrease in a deferred tax asset is a tax expense. Tax expense. Just the opposite of the first one. Okay. But to make it clear, to remove the confusion, just understand that deferred tax arises from differences between accounting principles. Okay, accounting principles and tax principles, for you to understand it clearly. For example, talk about the accounting depreciation. Talk about the accounting depreciation versus the tax depreciation. Which can be called wear and tear allowance or capital allowance. You know that these things cannot be the same. So the difference between accounting depreciation and tax depreciation will result into deferred tax. They cannot be the same. Why? The accountant has used accounting principles to prepare the income tax in his income statement. Remember, you as an accountant, you must recognize everything. You are going to record accounting depreciation, you record provision for bad debts, which are non-allowable deductions for for purposes of tax. And it means that you as an accountant, you're going to prepare or you're going to compute your tax, income tax based on the accounting principles. The one you are preparing during the year based on the accounting principle. But the taxman will come in now and prepare wear and tear schedule to get the tax depreciation. To get the real value of the what? Of the tax depreciation. Now, you will find that the accounting depreciation is different from the tax depreciation, and that difference must be recognized, must be reported in your statements. And B, is this deferred tax a liability or an asset? Okay, so we have types of differences. Types of difference, you have permanent difference and a temporary difference. With permanent differences, these are permanent difference is a difference between tax and accounting principle that will never, here, there is a word that will never be reconciled. They will never be reconciled. They will never be reconciled. That's why we are calling it a permanent difference. Talk about issues of entertainment allowance. You're not going to bring in, you see, temporary difference can be, it is a difference between tax and accounting principle that can be reconciled. Talk about you can reconcile this by preparing wear and tear. But look at a business that is not in entertainment, and they have incurred that amount of money. They have incurred that amount of money, and the taxman has disallowed that amount of money for tax purposes. There is no way that item or that amount will be reconciled. Okay? But with accounting depreciation and tax depreciation, you can reconcile by preparing. You can reconcile accounting depreciation by preparing wear and tear. So here you cannot reconcile. Here talk about entertainment allowances. The taxman will disallow such a kind of items, and there is no way you're going to reconcile. So temporary difference is a difference between tax and accounting principle that can be here. Here, this difference can be reconciled. So just to understand this, look at things that the taxman adds back, of which those items that are added back cannot be reconciled. Those will create permanent difference. But items that can be reconciled, those ones will result into temporary difference. Okay? Okay. Now, we have talked about deferred tax. deferred tax liability, deferred tax asset. But when do these ones arise? When do these ones arise? Deferred, and colleagues, when you don't understand this background, it is hard to pass the calculation number. It is hard, especially what we are going to talk about now. When do you know that you have deferred tax liability? You will have deferred tax liability if number one, if you are carrying value of an asset, here you are talking about an asset, is greater than the tax base. That is number one. For you to have a tax, for you to have a deferred tax liability, maybe there are some things I didn't talk about. This difference you will get, colleagues, here. The difference here can be taxable. The difference can be taxable or deductible. Also, you need to do that in your summary. I'm not going to confuse you. Okay. If the deferred tax liability, you have deferred tax liability if the carrying value of an asset is greater than the tax base. That is number one. Number two, if the carrying value of a liability, is less than the tax base. In such scenario, you will have deferred tax liability. Okay. Carrying value is computed using accounting principles. Tax base is computed using the tax principles. Then deferred tax asset arises if, number one, just make the opposite of this. Number one, if the carrying so if the tax base, if I start with the tax base, will it confuse you? Just you can change the sign. If the carrying value of an asset is less than the tax base. Then number two, if the carrying value of a liability is greater than the tax base. And here you are looking at deductible. The difference here is deductible. The difference here is temporary deductible difference. Okay. Then here the difference is temporary taxable difference. The difference between the two. Okay. Mhm. Okay. Any question here? I think they can make sense when we are also computing. But if you can understand here, especially here, if you compute carrying value, if you find that your carrying value is greater than the carrying value of an asset is greater than the tax base, the difference will be taxable difference. If you cannot that, then you are not going to fail calculation number. If you know that if I'm dealing with an asset and its carrying value is greater than the tax base, the difference I'm getting is taxable. If I'm dealing with a liability and I find that the carrying value of a liability is less than the tax base, then the difference is also taxable. Okay? And because the difference is taxable, it will create the deferred tax liability. Then if you are looking at an asset and its carrying value is less than the tax base, the difference will be deductible difference. And because that difference is a deductible difference, it will create a deferred tax asset. So when you're talking about taxable, it will result into a liability. If you're talking about a deductible, it will result into an asset. Colleagues, are we together? We go to calculations. Oh, there is a question here. Because this is the only summary we need. If there is a question, please ask before we go to calculations.
Abel,
Hmm.
just a small inquiry. That, for example, the temporary taxable difference, it applies for both when the carrying value of the asset is greater than the tax base and the carrying value of the liability less than the tax base. It applies on those two.
Yes.
Okay, thank you.
Yes. They apply here, just here, just here, or then here, or what? Or deductible. Yeah. Any other question? Colleagues, if you understand this here, you cannot fail any calculation related to this. So in the question, you need to know, are you dealing with an asset or you're dealing with a liability? Okay. Okay, let's now start answering. So we are going to start with March 2022. March 2022. Okay. Okay, let's read through our case study. They are telling us that KK Limited was incorporated in Uganda and prepares its financial statements in accordance with IFRS. Okay. The MD of KK Limited has been presented with financial statements that show profit before tax. This is profit before tax. You have profit before tax for each of the years from year 1 to year 3. But they are saying this is profit before tax for each year. So it means that each year is 1 billion. Each year is 1 billion as profit before tax. Okay. This profit is stated after charging. If you are in an exam, sometimes we don't see these words. Yeah? After charging depreciation expense of shillings 200 million per annum. This is also per year. This is due to acquisition of an asset at a cost of this in year one, which is being depreciated over its 3-year useful economic life on a straight line basis. Okay, it is very key also. They have given you the cost of an asset. The tax allowances. Now here you have allowances direct, granted for similar assets are shown below. You have tax allowances for each year. Income tax is at 30% of taxable profits. Taxable profits, colleagues, means profit before tax. Taxable profit means profit before tax. Apart from the above depreciation and tax allowances, there are no other differences between the accounting and taxable profits. What does this one mean? It means that what they are telling you is that if you see any difference, think about temporary difference because those are the only differences that can be as a result of accounting depreciation and tax depreciation. Tax allowance is the same as tax depreciation. Okay, in their recent, okay, this paragraph is none of our business because this paragraph is taking you to interim financial reporting, which is going to be applied when you are answering part C. So we need to just use from here up to here to answer part and part B. So part A, we are just going to prepare our extracts. Prepare our extracts without taking into consideration deferred tax. And how are you going to do this? Okay. Basically here you are preparing, your income, your statement of profit or loss, the extract. The extract. So you're A, I am ignoring. A is ignoring deferred or without taking into consideration deferred tax implication. Colleagues, the deferred tax comes in because of differences, or if you have a revaluation gain. Deferred tax implication. Okay, without deferred tax. Now we need extracts. Which company is this? This is KK Limited. Okay. Extracts of statement. Extract of statement of profit or loss. Is it account? Profit or loss, okay, for each year, for the years 1, 2, and 3. Okay, so I'm preparing my extract. Here I can put details because I'm dealing with different years. Here I can put year 1. I can put year 1. Then here I put year 2, then here I put year 3. Okay. We can, let me see how the figures are given. We can keep some zeros. Okay, we can keep 1,000, okay? So we can keep some can keep 1,000. This is my template, okay? What are you looking for? Remember, you're preparing a statement of profit or loss. Basically, we are looking for profit after tax here. We are looking for profit after tax. And in the question, you see that we don't have sales, we don't have all those items mentioned them. Other incomes, admin expenses, you don't have. What you have is profit before tax. That's what is given in the question. Okay, profit before tax. And this profit before tax is 1 billion for each year. And because we are keeping 3 zeros, I will just write 1 million for each year. This is 1 million, 1 million, also here 1 million. Okay. And then after this, remember you're looking for what? We are dealing with IAS 20, with IAS 12, okay? So you needed to recall that here we add back, for tax purposes, we add back accounting depreciation. That is non-allowable. Accounting depreciation. And why are we adding it back, colleagues? The question is, why are we adding it back? They said that this profit is stated, this profit before tax is stated after charging depreciation. So it means that this depreciation is part of the expenses that accountant included. So you have to add it back. So we are adding accounting depreciation of how much each year? 200 million, but I'm keeping 3 zeros. So I'm going to just record 200. It is also for each year. 200. Okay. Okay. Then we are given. Now you cannot go ahead and depreciate. Okay, if you depreciate already, if you get the cost divided by useful life, you'll find that you're actually getting 200 as depreciation, but it is already charged. So we don't need to again compute the accounting depreciation. Here, accounting depreciation, if at all we are not given accounting depreciation, you just get this cost divided by useful life. 600 million divided by 3, you get this. Okay, we are given tax allowances. Remember that for tax purposes, tax allowances are allowable deductions. Okay, they are allowable deduction, or they are normal expenses, which should reduce the tax, rather, which should reduce the income that should be taxed. So here we less tax allowances. And we are given tax allowances for each year. So year 1, it is this one. But colleagues, are we together? Are we together? Are you following?
Yes.
I'm talking alone. Talking to myself. Please, if
You're
there
not
is a
alone.
question, feel free to
We are
ask.
following steadily. Actually, we are
Yes.
understanding.
No issues related to tax. Some people fear tax. So, but tax is an interesting thing. It's my area. It's my area. So yeah, we race, okay? Perfect. So once you do this, then you need to know now what you're getting is what we call for tax purposes is like chargeable income, or what we call taxable profit. Because we don't have any other allowable deduction in the question. So you get your taxable profits. Okay. You get this plus the accounting depreciation. For you say minus the tax allowances. That's what I have. So that is my chargeable income. It is my chargeable income. After getting chargeable income, then we can get the tax, the income tax. And the income tax, they have told you that the rate is 30%. So this is like an expense, tax expense. So if I do this, it can confuse you. The 30% is 30% times taxable profits. So you just get your 30% times your taxable profits. Okay, that's what I have. Okay. But don't forget that this taxable profit will be subtracted to get the profit after tax. So once you have, this is like taxable profit, chargeable income, then income tax, you get part, that is profit after tax. You get your taxable profit minus the tax expense. And you're done with part A without taking into consideration deferred tax implication. That is part A. Part B of the question, they are saying part B, taking into account deferred tax implications, prepare extracts from the statement of profit or loss. That is number one, and the statement of financial position. So here you will need to prepare profit or loss and also the balance sheet, taking into consideration the deferred tax implication. Okay. So here we are taking into consideration the deferred tax implication. And it is also not hard. Simply what you're going to do is to copy this. Copy this up to taxable profits. Okay. You can first do this in your books. Once you reach here. Once you reach here, you will create an item for tax expenses. Because we are taking into consideration a deferred tax implication, you will have the current tax. Okay. Then you will also have an item called an increase or decrease in deferred tax liability. Because we said here if the difference is taxable difference, then you will have what we call deferred tax liability. And the deferred tax liability, we said that here, deferred tax liability, an increase in the deferred tax liability is tax expense. Then a decrease in the deferred tax liability is an income, which is like a tax credit. Remember, if it is an expense, we subtract. But if it is a tax credit, we add. It's an income, we don't subtract. It's just an income if it is a tax credit. So you will see that. You will see that. That's why I said this summary can help you. Okay, so it means that here we will need the working here. We will need the working. We will need the working here. But this one current tax, you can get direct. Because current tax is simply the tax on profit made during the year, on the taxable profits. So I'm going to multiply by this. But because this is a tax expense, I am going to put my figures in brackets. So for you, you put them in brackets, let me record them as negatives. Because this is an expense. You get your taxable profit minus your tax expense. Okay. So we need working for this. Okay. So we can create, this is our working one. Our working one. This is working one. Workings, this is working one. Liability or asset. The first question you need to know is, what is your difference? So here you need to first determine, since they say that the differences are only because of accounting and the tax allowances. So I can say determine the temporary.
Excuse me, Abel.
Yes, please.
We still have to do that thing again.
Which
If
one?
I'm doing part B, that extract, the way you had drawn, the way you drew it.
Yes, yes. because
Okay.
this is separate from part A. It is separate. You have to draw again. Because we are looking for profit after tax, taking into consideration the deferred tax, the deferred tax. So what can we first determine the temporary differences, that is between between the carrying value and the tax base. Okay, so you will have create a column for years. Also create column for carrying value of. Here we are only talking about an asset. We don't have a liability in the question. What we have in the question, what we have is only an asset, one asset. The acquisition of asset. We don't have a liability. We are talking about an asset. So this is the carrying value of an asset. Also put the column for tax base, its tax base. Then column for differences. And we are keeping our results. Okay. So we have year 1, year 2, and year 3. The question is, do you have carrying value? Remember, for you to get carrying value of an asset, you look at the cost minus its accumulated depreciation. Okay, so you don't have the carrying value of an asset. You don't have the tax base. How do you get the tax base of an asset? You get the carrying value, the cost. Sorry, you get the cost minus the accumulated tax depreciation. So we need also to do workings for this. Now, you know the cost. You know the cost of an asset. Cost of an asset. It is given in the question as how much? In the question, it is given as how much?
600 million.
600 million. Okay. We want to know what is the carrying value of an asset. Carrying value of an asset for year 1. This will be equal to the cost minus since this is the first year, you just say minus depreciation. But ideally, we use the accumulated depreciation. Okay. And the good thing, we are given depreciations, accounting depreciation direct, which is 200 million. If you're not given that 200 million, you can look for the depreciation. Here, the depreciation, you get 600 million divided by the number of years. So we are getting this figure, 600 million minus
You first come and pick these things from that.
600 million minus 200 million. How much do you get? Is it 400? 400 M. So that is my carrying value of an asset for year one. I record it here. I'm keeping 3 zeros, so I'm going to write 400,000 here. Then you look for the carrying value of an asset for year two. Carrying value of an asset for year two, you repeat the same formula. It is cost minus accumulated depreciation. The cost is 600 million. We subtract the accumulated depreciation. Remember, you'll be having depreciation for each year, but here we are looking at the overall accumulated depreciation. So you have to take into consideration the first depreciation, the 200 million, that is depreciation for the first year, then add depreciation for year two, which is also 200 million, because it is we are using straight line method. So this is 600 million minus 400 million. How much do we get? Is it 200?
200.
This is 200 million. I can record it here. So I record 200,000 because I'm keeping 3 zeros. Then lastly, what is your carrying value of an asset for year 3? You repeat the same. The cost, which is 600 million minus accumulated depreciation. I simply get 200 million times, I can get also times 3 years. It's also the same. Or you get 200 million plus 200 million plus 200 million, but that wastes a lot of time. Okay, so yeah, this is 600 million minus how much? Minus 600 million, isn't it? So finally, you are getting 0. So here you record 0, nil, or you record nil. Okay. What about the tax base? I can also do the working to get the tax base. What is the tax base? Tax base of an asset for year 1. For in year 1. Tax base of an asset year 1. You are going to simply get your cost of an asset minus accumulated tax depreciation. That is the formula we are going to be using here. Okay. So the cost will remain the same, 600 million. We subtract, what is the tax depreciation for year 1? Tax allowance is 240. So here I say minus 240 million. How much do you get? 3 360 million, okay? You record it here. 360 million, which is the same as this. You do the same for year 2. Okay? For year 2, you do the same, but here you remove 1 and put 2. So the cost will be the same. It will be 600. I open bracket because I need accumulated tax depreciation. So I get tax depreciation for year 1 to 40 million. I add tax depreciation for year 2. Tax depreciation for year 2 is 210. 210. If you add there, if you add, how much do you get? This is 450 million. Finally, what is your answer? 150? 150 million. So I record here 150. So you do the same for the last year. Remember, we are looking for 10 marks. Last year, it will be 600 million minus accumulated depreciation. Depreciation for year 1 plus depreciation for year 2, which is 210, plus depreciation for year 3 is what? Tax depreciation for year 3, it is 150. $150 million. So finally, how much do you get? I think if you open a bracket, you will get 0. If you do everything, you will get 0. So here also it means that it is nil. So what is your difference? You subtract. You get the carrying value minus the tax base. Okay. Here it is. These are your differences. So the question is, are these differences taxable or deductible? Are they taxable or deductible? That's what I was saying here. If the carrying value of an asset is greater than, if here you are getting a positive figure, if the difference is positive, here if the difference, here if the difference,
accumulated tax depreciation. Accumulated tax depreciation.
Where exactly?
This one, where this 240, 600 minus 248.
It's in the question.
This one.
Questions.
Yes, that one.
Remember, that is tax depreciation here. Are you seeing?
Oh, this one, which way they say the tax allowances?
Yes.
Okay.
Okay. So the difference, is it taxable or deductible?
Taxable.
If your answer is positive, then the difference is taxable. Mm. Okay. So here our differences are taxable. These are taxable. And the moment you find that the difference is taxable, then think about tax liability. We say the moment the difference is taxable, then we will have a deferred tax liability. But if the difference is deductible, we will have a deferred tax asset. So finally, the working we will need to do is 10 marks, but you have to sweat. So remember, we need just the difference. We need to report now. We need to report in year one. In year one, what is your deferred? What is your deferred tax liability? Remember, for you to get deferred tax liability, you get the tax rate times the taxable difference. Okay. And in year one, we are going to get that 30%, the tax rate 30% times the tax difference in year one, which is 40. Which is 40 million. 40 million. Finally, you will have how much? 30% times 40 times 40. Let me just multiply by 1,000. Okay. Okay. That is my deferred tax liability in year one. What are the entries here? Entries that you can pass. You debit. Remember, whenever you have a taxable difference, that is a tax expense. You need to pay. So here you debit profit or loss account. This is like the tax expense. Or credit the liability, deferred tax liability account. This is a liability. Remember, a liability has a credit balance. That is number one. Then in year two, what will be your deferred? What will be your deferred tax liability? Sorry, don't do that. Here it will be equal to the 30% times what is our difference? 50. This is the difference, taxable difference. 50. So here we are multiplying by 50 million. Okay. This will be equal to 30% times the 50 million. That's what I have. 15 million. Okay, what are the entries? It means that ideally, it means that here, what does this one mean? It means that a liability has increased to 15 million from 12 million in year one to 15 million. So it means that you have an increase in a liability. You have an increase in a liability. Okay, before we do entries, colleagues, we are saying here, year one, debit your profit or loss account. Remember, you have profit or loss. You have profit or loss this side. You have tax expense here. So your expenses are increasing here since you're debiting. Eh? So you have to report that here. We are reporting how much? 12 million, but we are keeping 3 zeros. Colleagues, are you understanding why I'm putting here 12? Okay. I remove 1 0. Have you understood why I'm putting this figure here? Have you understood why I'm putting that figure here?
Yes, I don't know. About
We want to know which figure can we record here in year 2. Which figure can we record here? Remember, your liability has increased from 12 million to 15 million. It means that there is an increase in a liability. Every time you have an increase in a liability, that is an expense. And this expense is tax expense. So it means that here you're going to debit your profit or loss account, as a tax expense, but of how much? The increase in a liability, 15 minus 12, that is 3. Because this liability is in your books, for you, you're just going to add. Then you credit deferred tax liability with the 3 million. Here we cannot put 15. Why? This liability is still in our books. We are just increasing the liability. If you get 12 million that is already in our book, we add 3 million, we will be in a position to get 15 million as a deferred tax liability in year 2. Okay, so we report. Come here. We are debiting a profit or loss here, so we are putting negative 3,000. Okay, then in year 3, the last one, in year 3, do you have a deferred tax liability? Remember, it is rate 30% times. Do you have anything here in year 3? We don't have any difference, so it is 0. So times 0. So you will get here nil. What does this one mean for double entry now? For double entry, what will happen? It means that ideally we don't need to see any liability in year 3. Okay, so what are you going to do to make sure that the liability is nil in year 3? you had a liability of 15 million in year 2. But in year 3, you're saying that there should be no liability. So there is a decrease in liability from 15 to 0. That is a decrease. Here you don't have an increase. It's a decrease in liability. And a decrease in liability is an income. It's a tax credit. Okay? So since it is an income, since a decrease in liability is an income, it means that you're going to reduce your liability by debiting. Remember, for you to reduce a liability, you must debit. A liability has a credit balance. For us to reduce that liability account, we debit. We debit the deferred tax liability account. Okay? With how much? With 15 million. Because we are reducing that liability to 0. From 15 to 0. 15 million. Then I credit what? I credit now. This is an income, so it will be profit or loss. It's an income. Remember, an income has a credit balance. Incomes increase by crediting. This is basically tax credit of 15 million. So what does this one mean? It means that you will come here on your year 3. Since it is a tax credit, since it is a decrease in liability here, you will not put figure as a negative. Instead, it will be a positive 15. And you're done. You're done with everything. Simply what you're left with, is to just get the profit after tax. By getting your taxable profit minus
Excuse me, Abby.
Yes.
I don't know, that's why you have the 15 in the last column for year 3.
Pardon your question?
The 15,000 in year 3, that very thing where you are.
You are not understanding where it is coming from.
Why do you have 15? Okay, why do you even have that whole row of increase and decrease?
Because we are putting into consideration the deferred tax implications. Okay? Because of these differences here, this is where we started, getting these differences, then after you come here. In year 1, what is deferred tax liability because tax implication? The differences here in accounting. The differences here in accounting and tax depreciation. So here, first one, in year 1, you have first liability of 12 million. We made a double entry. And the double entry here you have is that you are going to increase, debit the profit or loss account. And which item is going to be affected in your profit or loss account is tax expense. Remember, every time you're debiting an expense, it means that your expenses are increasing. And expenses are negative items in profit or loss account. That's why you see the first item here, I had a negative 12. Someone who asked, are you on?
On.
Are you seeing where this 12 is coming from?
Mm.
Then in year
The
2,
difference. Mhm.
in year 2, you also do the same. You first get what? You first get a tax liability. By getting 30% times the taxable difference. These are your differences here. These are taxable difference. These are taxable differences. Okay. Let me hope now it is clear. Then in the last, okay, here in year 2, initially you had a liability of 12 million, but now a liability is 15 million. It means that your liability has increased, and an increase in a liability is an expense. But this expense is tax expense. We are talking about tax expense. That's why here you have 3. Then lastly, since here you have no liability, it means that your liability has decreased from 15 to 0. In year 2, you had a liability of 15 million. But in year 3, you have no liability. So it means that your liability has reduced from 15 to 0. And a decrease in liability is an income. This income we are talking about here is a tax credit. So since it is an income, you don't record it as a negative. You record it as a positive. That's why you see here I'm putting 15. Siama, is it clear?
Yes, it's clear.
Okay. Okay, so we are done with the, just here get the differences. Here you get this taxable profit minus your current liability, rather current tax. Then if the figure here is a negative, you say minus. Get this figure minus this minus this. Get this figure minus this plus this. That is your extract of statement of profit or loss. Finally, you need now the last one, which is balance sheet. Doesn't take time. It's just 3 items. Extract of 10 max colleagues. I have to say it, eh? Extracts of statement of financial. That's why we can't finish in this paper. By the time you finish question 1, you're disorganized. Coming back here, you are. So it is a struggle. It's really a struggle to finish in this paper. But what it's not all about finishing. It's all about writing the correct content. The few things you write must be correct. We have year 1, year 2, then year 3. And here, this is simply an extract. This is all that. This is, you remove this. This is all that. This is all that end of the years. Pardon? Samasa, you have a question? So that is my extract. This is extract. You just need to record what you have. 1, when you check what did we say? We said deferred. How is deferred? How is the deferred tax liability recognized? Deferred tax liability is recognized as non-current liability in statement of financial position. Okay. But when you check in this question, you have actually a non-current asset. You have a non-assets. Here you have non-current asset. You record a non-current asset at its carrying value. The non-current assets, remember we acquired an asset. We acquired an asset. This is an asset. So at the end of year one, what is its carrying value? We computed those values. What were the carrying value of an asset? This one, 400D. Then year two, in year two it was this. In year two it was this, 200. Then in year three, we have nothing. Okay, are you seeing this? Let me hope this is clear. Okay, then next, what do we have? We don't have current assets in this question. So we have liabilities. And for liabilities, what do you have? You have a non-current liability. You have non-current liability, that is your deferred tax liability of, we have deferred tax liability of each year. The first year is how much?
12 million.
12 million. Then the next one is what?
It's 15 million.
15. Then lastly?
Lastly, it was 0.
Okay. Do we have current liabilities? Colleagues, we have current liabilities.
Which is the tax.
Yes. We have current liabilities. And we said which current liability now? Do you recall this?
Current tax.
Samantha. Yeah. Current tax is recognized as both an expense in profit or loss account and current liability in statement of profit or in statement of financial position. So here, the current liability you have is basically the current tax payable. This tax you computed here is not yet paid, this one. That's why it is a liability. It's outstanding. Okay, so here it is how much to just 2.8. Then here it is 2.9. Yes. Then the last one is what? This. Someone may be saying that, what about this? Colleagues, this one you have already incorporated into this. So that's all about this question, because these are the only extracts. Any question here? We are done with the number. But in an exam, colleagues, you can spend like 40 minutes on this or that, depending, because if you know, you know. You don't need it. It's not like a discussion. It may be issue of calculator, but if you know, sometimes we can be fast. But a discussion like now, network, what? So that's all about 15 marks. And this one we needed to read. Minimum components, form content. So colleagues, that's all about this question. In case you have a question, please ask. If you are not tired, we can look at other, we can do some other questions. Or we stop here. Samuel, are you on? You are quiet. Or your neighbor cannot allow you to talk.
Around.
You're on, right?
I'm very
Okay.
on. Yeah.
Can we proceed?
Yes, we can.
Yes, we can.
Okay.
Let's proceed.
Is this color okay to your side? Is it okay?
It's okay.
Because I want to make sure to be sure that you can be in a position to read. So read it through just 1 minute and see whether you can actually answer. Remember, in the question you were to prepare basically what? Consolidated statement of financial position, that is balance sheet. So in the balance sheet, you should know the implication now. If you're handling a note about tax, what should be now appear in the balance sheet? It is either deferred tax liability or deferred tax asset. So as you analyze here, that is your interest. It is your interest. Maybe also the asset that may be here. You read this through. So they are telling us that on 30th June, we need to know what is the reporting period first. The reporting period is 30th June 2018. Okay, that's the reporting period. And they are telling us that on 30th June 2018, Tangas Limited, this company's building that was acquired on what? On which date? That was acquired on 1st July 2008 at a cost of this is the cost of the building, had a recoverable amount of this. So this recoverable amount is on which date? This recoverable amount is on 30th June 2018. So every time you see the word recoverable amount, think about impairment loss. You need to test for impairment. Depreciation is chargeable on straight line basis over 35-year period. Very key here, because you will need the carrying value. Okay. The tax base and the carrying amounts of non-current asset before impairment. Before the impairment written down were identical. If they say we are identical, it means what? It means that before impairment, the tax base and the carrying amount were equal. Okay, or were the same. The impairment of the non-current asset is not allowable for tax purposes. We all know that. Accounting impairment is not allowed. Tanga Limited has not made any impairment or deferred tax adjustment for the above and expects to make profits for the foreseeable future, and the tax rate is this one. So you're the one to adjust this. You're the one to look for the impairment and know the impairment will affect what in your balance sheet. Then you also say whether you have a deferred tax asset or deferred tax liability. Okay. So this is the August 2018. Question 1. Note what? Is it note 6? Is it note 6 or note 7? Okay, paragraph 7. Okay. So we are handling the notice about. So yeah, you will need, as you do your number, you will need, of course, you'll be having your workings. Assume that this is our working in number 7, not 7, and this working is talking about building. Okay. So the cost, you have the cost of the building on 1st July 2008 as how much? The cost of the building is how much? 350 million. Okay, 350. We can keep our figures in millions, shillings in millions. Then the life, how many years? 35 years. Okay. So you know that initially this is an asset. Initially an asset or the building should be recognized at its cost. That is initially. You recognize an asset at its cost, and subsequently you depreciate. Okay, subsequently you choose if you're dealing with IAS, is it 16? Yeah. You choose between cost model and what? Evaluation model. If you choose the cost model, of course, subsequently you're going to depreciate over the useful life. So here you can maybe write something, but with the question 1, we don't need to report all that, write all that, I think. But you just need to know that with building, initially, building should be recognized at its cost, and subsequently, for this question, subsequently, we depreciate over its useful life of 35 years as below, like this. Depreciation, what is our depreciation expense here? For depreciation, we are getting the cost over life. Okay. Which is 350 million divided by 35 years. What do you get? 350 divided by 35. Okay. And this is per year. Now, as you do these workings, colleagues, we need to know, are we given a revaluation? Are we given a recoverable? Those words will help you to know what you should do then to do next. Because here, ideally, what you're looking for is the carrying amount, but the carrying amount as at which date? You have, when was your evaluation? Okay. Here you actually we have recoverable amount, but this recoverable amount is on which date? 30th June 2018, and 30th June 2018 is our reporting date. So at reporting date, that is 30th June 2018. What is the carrying amount? What is the carrying value of the building? So that you compare this carrying value with the what? With the recoverable amount and see whether you have impairment or not. So the carrying value is the cost minus the accumulated depreciation. Which will be equal to what is the cost? 350 minus accumulated depreciation. The depreciation for each year is 10 times now how many years now? You have to count from 2008 to this date. How many years? Count using your fingers and tell me. From 1st July. From 1st July 2000. How many?
10.
Okay. So we are multiplying by 10 years. Let me hope you are right. Okay. We have to use our fingers and we count. So finally, how much do you get? The overall is 350 minus 100, which is 250. Okay. That is our carrying value. But what is our recoverable amount as at this date? Recoverable amount is equal to, in our question, what was our recoverable amount? 185. 185. So the question is, do you have impairment or not? Do we have impairment or not?
Yes, we do have impairment.
Yeah. The moment you find that the carrying value is higher than the recoverable amount, then you have impairment loss. There is impairment. There is impairment loss of how much? 185 minus 250, which gives you how much? 65. Okay. At this point, you can. What are our entries here? Impairment loss is an expense actually. So you debit here. You debit PL.
P and loss, that is impairment loss, and credit the assets.
Yeah. It means that your asset has lost value. PPE, which is building. But in your balance sheet, you'll be having PPE. So it means that now immediately you go now if you have your template, immediately you go to your template and reduce where you have PPE, you reduce 65 immediately, since we are preparing a statement of financial position. If we are preparing a statement of profit or loss, then we immediately go to our income statement under admin, or where they have said, because they will direct where this impairment loss is charged. Can be charged and to cost of sales or to administrative, depending on the exam. Okay. Okay, but now we need to proceed. We have impairment. Okay. They are telling us that the tax base and the carrying amounts of the non-current assets before impairment written down were identical. Okay. So before impairment, here, before impairment, what were the carrying value of building? What was the carrying value of the building? It was actually 250, isn't it? And since they are saying that the carrying value was identical, then also the tax base is 250. Identical, okay? Yeah. Let's see, and let's continue and see. Okay, the impairment, okay. So that's all we have. Now, colleagues, you need to know that since we are testing, since we are trying to find out whether we have deferred tax liability or deferred tax asset, we need to compare the carrying value with the tax base. However, we need this as that the reporting date. As that the reporting date. And you see that as at the reporting date, this is actually after impairment. This is actually after impairment. It means that the carrying value at the reporting date will not remain like this. But if you go ahead and compare like this, you'll find that actually you have no deferred tax or deferred. Yeah, because the difference will be 0. But here you need to recall that since we look for deferred tax implication as at the reporting date, then we need to know what is our carrying value of the building. The carrying value of the building is now the recoverable amount. Do you agree? Do you agree, colleagues?
Yeah, I agree.
Yeah,
Okay.
yes,
Then,
it's right.
pardon?
It's right. Yeah, it's a recoverable amount.
Okay, okay. Then what about the tax base?
Tax
The tax base is not affected by the impairment. Because what can affect your tax base is tax depreciation. You get? Remember, to get the tax base, you get the cost minus the tax depreciation. But the fact that in this question, we cannot tell the tax depreciation. That's why examiner had to bring in this statement that the carrying value of the building and the tax base before impairment were equal to this. Now that you pick from here. So here you will be to remain the same. Since we cannot tell the tax depreciation, you cannot assume. So if you have this at the reporting period, the question is, the difference between carrying value and the tax base, is it taxable or deductible? This is an asset. And you see that the carrying value of asset here is less than the tax base. What is here? Do you have a deductible difference or a taxable difference?
A deductible.
It's a taxable. It's a deductible. Temporary.
Deductible.
Taxable.
Deductible. Yeah.
Deductible.
Here we have a deductible
Temporary difference.
temporary deductible difference. Okay. And since it is temporary deductible difference, it will result into what? This will result into
A deferred tax asset.
this will result into what is your deferred tax asset? It will be the tax rate times the deductible difference, which will be equal to tax rate 30% times the deductible difference 250 minus 185. Finally, how much do you get? Using your calculator. This is 30% times, is it 65 if we get 250 minus 185? Then finally, I have okay, that's what I have. So that's what you will report. A deferred tax asset. If you were to draw your journal entries, you debit your asset, deferred tax asset, because this is an asset. All assets have a debit balance. They increase by debiting. Then we credit what, colleagues? We credit what? This is an income. Okay? This is an income which will go to profit or loss as a tax credit. This is a tax credit. So if you're preparing profit or loss, this is what you take. You add. Where you have income tax expenses, you add 19.5. But if you're preparing balance sheet, you go to where you have your, but this is, some people create it as a separate item, but this can be part of your non-current assets. That is PPE. Where you have PPE, you add this. So that's all about this note. Let's handle the last note. Which note should we do? Which note should we do?
2023.
May 2023, the current one. Okay, let me see whether we have. Okay, May is here. It is note number what?
Number 7.
Note number 7. Let me see whether it is. Yeah. You see that. Okay. Assume that other assets and liabilities had no deferred tax effect. What are we preparing? We are preparing profit or loss. Okay. As at which date? For the year ended 30th September 2022. The reporting date is very key because that's where you need it to test to see whether you have a taxable difference. Okay, so let's read through and see. They are telling us that Piana, October 2019. Purchased an item of PPE on 1st October 2019 at a cost of this. So you have a cost. 2.5 million. That is number one. On which date? 1st October 2019. On 1st July 2020. That is another date. And this date is not the reporting date. Because the reporting date is which one? 30th September 2022. But they are telling us that on this date, 1st July 2020, the machine was revalued. So here you needed to test. On this date, you needed to test to see whether you have revaluation gain or revaluation loss. Revaluation gain is an item of OCI. Then revaluation loss is an item of to go through the profit or loss.
But Abdel,
Yes, please.
I see there the financial, you have interest on the financial which we are working in. So if you get
Yes.
that revaluation gain or loss, will it be of help?
Yes, it is helpful in a way that, remember, if in the previous years in the previous year you had a loss and now you get a gain in the current year, we do what we call a reverse. Do you recall that? A reverse. If you had a gain of, let's say, 10 million and now you are making a loss of 7 million, then you'll find that the gain will first be deducted. And, okay, we are going to say that, but it is very key to test at that very point.
Okay.
It is not the reporting date, but test. So very key. The machine was revalued again too. This word is very key. the machine was amount to 1.3 million. So we have this still 30th September 2021 is not what? Is not our reporting period. Depreciation is charged at this rate on straight line, while the capital allowances are claimed on straight line basis at 30%. This company had a tax liability, deferred tax liability of this. This is in the previous year. So this one you need to be very active. This one we are handling which note? It is May 29, May 2023. May 2023 question 1, note 7. And it is talking about what? Which kind of asset? PPE, yeah?
Yeah.
What was the cost? What was the cost initially? It was 1st October 2023. And the cost was how much? The cost was 2.5. Since we are keeping 2.5, let me just write 2.5 as 6 shillings in the middle line. We are depreciating using which method? Reducing balance or straight line method? Huh? Please don't dose. We are using which rate? 25%. Okay. This is straight line basis at 25%. Okay. So I needed first to know what is the depreciation of this depreciation expense per year. Before I do anything, what is depreciation expense per year? I get 25%.
Anyone with the question paper of May 2023 to share in the group? Or a screenshot of the question?
Someone can screenshot and share. 25% times 2.5. That's what I have. And this is per annum. Someone can screenshot and share. So this is our depreciation expense per year. So as you know, once you know the depreciation expense per year, ask yourself, you're going to get your carrying value on which date? You're focusing on which date? On the date you had the first revaluation, that is 1st July. On 1st July 2020, what is our carrying value of PPE? It will be equal to cost minus accumulated depreciation. And the cost is what? 2.5 minus accumulated depreciation. I get the depreciation for each year, 0.63, then times how many years? From 1st October 20, Is it correct? Is it 1st October 2023 really? 2019. Eh? Here it is 2019. 1st October 2019. So how many years? Colleagues, all count the number of months from 1st October up to this date. Tell me the total number of months. We just divide by 12. I'm waiting for you. If you keep quiet, I keep quiet.
Nine months.
Someone is saying 9 months.
4 years.
9
Pardon?
months.
Have you all confirmed the 9 months?
No,
Yeah,
4
9
years.
Eh?
Yeah, 9 months.
Also, October 2019 to the reporting date is 2020.
No, we are not yet. We are not yet there. We are not yet there.
Sorry.
We are here. 1st July 2020. So those are 9 months. So I'm going to multiply by what? By 9 out of 12. And how much do you get? Using your calculator very fast. 2.5 minus open bracket 0.63 times 9 out of 12. That's what I have as carrying value. Then what is your valuation, the valued amount? The valued amount as at this date. In the question, the valued amount is how much? The machine was revalued at this.
At 1.875.
Okay.
1.875. That one.
87. It is 875, eh? Okay. Okay. So do we have a revaluation gain or revaluation loss?
Revaluation loss.
This is revalued amount, but so here we have revaluation
Loss.
loss. Of how much? Okay, that is a loss. You put a star. You put a star. Then you proceed. You proceed. When was the next revaluation date? The machine was revalued again. The machine was revalued again. Shillings 1.3 million on 30th September 2021. This is still not the reporting period, but you need it also test and see. So here, the next is on 1st. On, is it? Which date? Which date? 30th September. On 30th September, on 30th September, 30th September 2021. The question is, what is the carrying value of the machine, of this machine? It is equal to cost minus accumulated depreciation. But recall, colleagues, the moment you revalue, the initial cost must change. You cannot rely on the initial cost when you had the previous revaluation. So the cost will be the previous revaluation. So what is our cost here? What was our previous revaluation? The valued amount 1.8.
It's 1.875.
Then minus now you have to depreciate based on the revaluation amount or valued amount. So I can first let me see. No. We can get the depreciation expense here will be equal to what? The valued amount, which is 1.1 is 20, the rate is 25% times the valued amount 1.875. If you want to know. But if I realize that I didn't do that, then I can do it from here direct. 25% times the valued amount to get the depreciation for each year. But I ask myself, from 1st July 2020, to 30th September 2021. How many months?
It's 1 year and 5 months.
Okay, tell me the total number of months.
12 plus 5, that's 17. 17 over 12.
So I multiply by 17 over 12. What do you get? With some speed, colleagues. With some speed. Need it to finish up.
How is the 17 over 12 coming about?
From 1st July. From 1st July. Remember, you're looking for accumulated depreciation. So you get from 1st July up to 30th June, up to 30th September 2021. How many months? Someone is saying 17 months. But I don't know whether it is correct.
So if it's 17 months, does it have to be to over 12 now? Because then the months are more. Like
Yes.
it's more than a year. It
It's
can be
more
over
than
12. It's more than a year.
Yeah. So if you want to, okay, this is the easiest way. Let me tell you, this is the easiest way. Otherwise, when you want to say, and it doesn't take time, another person can say, oh, this is 1.2. But this is the first one, the easiest way. And first say, okay, I first look at 1 year, I get this 25% times 1.875. That is depreciation for 1 year. Are we together? Times 1 year. That is depreciation for 1 year. Plus, I get 25% times 1.875 10 times the remaining months. 5 out of 12. You still get the same answer, but this takes a lot of time. Sam, is it okay?
Yeah, it's okay.
So how much do you get?
Excellent.
You type in the chat, I can't hear you. Someone who's audible, can talk? Or you
1
can
point. I'm getting 1.2109.
1.209, like this, eh?
2109.
You maintain 3 decimal points. 2, 1,
It is
0,
it is
like
it
this,
is
eh?
yes, 211.
Okay. Then on this date, what is the varied amount? On this date, what is the varied amount? On this date, the varied amount is 1 point what?
1.3.
1.3. 1.3. So do you have a gain or a loss?
The revaluation gain.
We have a gain here. Okay, of how much? It's this minus. Okay, that is a gain. But initially you had what? You had a loss. So
Loss, yes.
you have to net off.
Net
eh?
off.
Net off and see the balance. The balance, will it be a gain or a loss?
It's going to be a loss.
Net. It will be a loss, eh?
Yes, it's going to be a loss.
Net revaluation. Net revaluation. Valuation loss. Okay. Is equal to this minus this. Let me hope we are on the same track. So here we have a loss. Okay, we continue. Okay. The next date is when? Now we are done with all dates and the question. We now need to look at the reporting period. At the reporting period, that is from the reporting period 30th September 2022. What is the carrying value of this machine? It will be equal to cost minus the accumulated depreciation. But do you think we are doing the right thing?
Yes, it's the right one.
Yes.
Yeah, you're on the track.
Okay. Okay. So, if you have understood here, which cost are we using?
1.3.
We use the previous
No, use
revaluation.
that. Using the current one, 1.3.
Minus the rate 25% times the cost from 30th September 2021 to this. I think here it is 1 year.
It's 1 year, yes.
It's 1 year. Huh? How much do you get?
You get 0.975.
0.975. Perfect. So this is the carrying value as at this date. Here we don't have revaluation. We cannot test, we cannot compare. This revaluation, it means that this revaluation loss, it means that it was recognized in the books or in the books for the period for this financial year. Are we together, colleagues? So in this financial year or in this reporting period, you cannot talk about revaluation. If at all in this scenario we had revaluation gain or revalued amount, we could compare and see whether we have revaluation gain or loss. And we also again get the net. But since we don't have revalued amount in this reporting period, then what we are interested in is to know the tax base. What is the tax base? As at 30th September 2020. Remember, the tax base is the cost minus the accumulated tax
Allowance.
or depreciation. Okay. The cost here, when you're dealing with the tax, the cost you use must be the cost you incurred to purchase an asset. You don't use revalued amounts here. You use the cost you incurred to purchase an asset. How much was that? 2.5, eh?
Plus 2.5.
2.5 minus accumulated depreciation. What is the depreciation rate here?
30%.
Okay. Get 30%. Now count from the date you purchased an asset. This is 30% times the cost, that is your depreciation, but times now how many, is it on reducing balance first of all or straight line?
I think it was straight line.
Okay, it was straight line.
Straight line.
Otherwise, if it is reducing balance, now it makes it, you have to get carrying value of each year. Okay, here count how many years from the date we purchased this machine. 1st September 2019, rather 1st October 2019 up to 30th September 2022. I am waiting for you. Tell me the total number of months.
Number of years.
Now I need the number of months. Total. Because you see this financial year normally start on 1st October. This one. And this one you see it is yeah. Since this one starts on 1st October, you can count the number of years. Yeah. So how many? 2020, 2021, 2022. Those are 3 years, eh? And 3 years. So finally, what do you get?
The answer is 0.25.
Like this, eh?
Yes.
Okay. So, do you have, this is your carrying value. You have the carrying value. Okay. You have the tax base. The question is, do you have a taxable difference or a deductible difference?
Taxable difference.
Taxable temporary difference.
Hmm?
It's
The
taxable
taxable
temporary difference.
Okay. So you have, since carrying value is greater than the tax base, this is the carrying value of an asset, not a liability. If it is a liability, it makes a difference. Then the difference is the taxable difference, which results into what? A liability or an asset, which results into a
The
deferred
liability
tax.
tax
liability
liability.
of a 30% tax rate times the taxable difference. Okay. So the rate is 30% times the taxable difference 0. This minus 0. How much do you get? Times the opening bracket, this minus this. Colleagues, that's your answer. Okay, that's your answer. Now, remember, in the question, we have what? A deferred tax liability of
Brought down.
yeah, this is brought down. Okay. So you compare and see whether you have an increase or a decrease. So here you have deferred tax liability brought forward of in millions. If you convert that figure in million, that is 0.170. Okay. So the difference, is it an increase or a decrease?
It's an increase.
Initially, this was the balance in your figure. You started the year with a deferred tax liability of this, but you ended the year with a tax liability of 0.218. So it means that here we have an increase in deferred tax liability.
Yeah.
So what does this one mean? You needed to know what you're preparing. Remember, we are preparing profit or loss. So an increase in the deferred tax liability, debit profit P&L of the difference. So what you're debiting is basically the tax expense.
The tax expense, yes.
Then if you're preparing a balance sheet, you you go to where you have deferred tax liability or
Tax
under your non-current liability
liabilities.
and put that. This is a non-current liability, deferred tax liability. So if you are preparing balance sheet, you add this figure. Because already this figure will be on your balance sheet, you just increase by adding the list to come. So colleagues, that's all about that note.
Abe,
All they need is
excuse me.
to know the implication, what you should. Remember, you need to know, as you do these workings, colleagues, you need to know what is the impact. You're preparing profit or loss. So among all the
Excuse me.
things that is necessary, what you need is only this.
Hello.
Yes, please.
Okay, I thought my mic has a problem. I have a question on that part of 2019. Let's scroll up once.
2019, eh?
Is it 2019, 20? Where on the same question we are doing? It is part
Where exactly?
for 17 days, 17 months. How may I have 1 year and 3 months?
I don't know. I don't know. You again count using fingers.
Still, I have 1 year and 3 months.
So in the total you have for you have what? How many months?
14 and 15.
You have 15. Oh,
Yeah, 15.
you have 15. Okay, I don't know. Colleagues, you will count. You will count. But let's count. Okay, count again. July. Me, I normally look at a year by a year. July, August, September, October, November, December. So in 2020, I have 6. Now I add. I think that they are 15, not 17.
Right.
Are you saying that, colleagues?
Yeah, she's right.
But good thing this one has no impact. It has an impact on our answer.
It is a valuation gain.
What do you get here? 875. 15, that's what you have. This is still a gain. The carrying value is lower than the valued amount. There is a gain here. Okay. So finally here, if you want to netto, still you have a revaluation loss. Jane, is it clear?
Yeah, it's fine.
But it is not no impact on our final answer. Since on 30th September we are relying on the revalued amount as the cost, the previous revalued amount.
Yes.
Okay, thank you. Any other question? So colleagues, as we do these notes, we need to know why are we actually doing this note. It's not just doing the note, but what is its impact on what we are preparing. Let's stop here, try other numbers.